Hello, everybody. This is Manisha from Vinod Kothari Consultants. And today we'll be getting into an NBFC regulatory refresh, a short summary on the regulatory changes that were introduced during the year FY 24-25. Now, without further ado, let's get into it. So the first amendment or the change was actually introduced on November 7, 2023, which is the IT governance directions. Now, the IT governance directions, however, was introduced in November 2023, but it became applicable from 1st April 2024. The directions are applicable to middle layer NBFCs and above, and it also repeals Part A of the erstwhile master directions, which is Information Technology Framework for NBFC in 2017. It shall be noted that base layer entities shall keep following the erstwhile master directions. Now, the IT governance directions establishes a comprehensive IT governance framework addressing the strategies, risk and performance management and business continuity of the NBFC. The key responsibilities introduced or that are listed in the directions are on the board, the IT strategy committee, the IT steering committee, information security committee, and the senior management to ensure oversight, implementation, and alignment of the IT with business goals. Now, the directions emphasizes secure IT infrastructure, vendor risk management, change and patch management, data migration, protocols, and audit trails. Additionally, roles of head of IT and the chief information security officer are clearly defined in the directions. Regular cybersecurity audits, assessments, vulnerability assessment and penetration testing, disaster recovery drills are mandated along with access controls. IS audit must also be followed and it shall ensure a risk-based approach under the oversight of the audit committee. KFS. Now, KFS is a standardized, concise document that provides borrowers with a clear, at-a-glance view of all the key loan terms. It was initially introduced through the digital lending guidelines. However, from this circular, it was made applicable to all retail and MSME term loans, including digital, microfinance, and home loans. Now, the KFS it promotes simple, transparent, and comparable communication of loan conditions, helping borrowers comparing offers across lenders and making informed decisions without any legal jargons. The contents of the KFS include sanction amount, disbursement schedule, installment details, the interest, the type of interest, annual percentage rate, all fees that shall be charged, contingent charges, grievance redressal information, any outsourcing information that is requisite, and co-lending information. The intent of the KFS is to enhance transparency and borrower awareness by mandating fair disclosure in a uniform and understandable format. Charging of interest. Now, the charging of interest circular was brought with the intent to reinforce fairness, transparency, and borrower protection across lending products. RBI observed that certain lenders were charging interest from the date of sanction of the loan or from execution of loan agreement, and the date of dispersal was days later. It was also observed in the instances of check dispersals that the interest was being charged from the date of the check and the check was handed over to the customer days later. Third, what RBI observed was that the lenders were collecting one or more installments in advance, but the full amount of the loan was being considered for charging the interest. RBI then said that the key actionables for NBFCs in this case should be that the interest starts only from the date of disbursement and not just date of the check. Advanced EMIs should be captured correctly in the loan. Additionally, it was directed that the past practices of NBFC shall be reviewed and excess interest, if any, collected by the NBFC shall be refunded back to the customers. Guidance note on operational risk management and operational resilience. Now, the intent of this guidance is to integrate operational risk into the overall risk management of the NBFCs. The guidance note applies to all NBFCs, including HFCs, and extends the scope of operational risk oversight beyond just the upper and middle layers, including the base layer NBFCs as well. While this is not a binding regulation, the regulatory expectations are set by the guidance by encouraging adoption of the best global practices, aiming to strengthen the resilience to operational disruptions, ensuring continuity of critical services, sound governance, and improved risk preparedness. The major actionables for NBFCs under this guidance shall be incorporating an operational risk management function under the three lines of defense model, define and assess critical operations and set impact tolerance metrics, update the risk management policies to include operational risk identification, mitigation, and monitoring, strengthen third-party risk management covering all the material dependencies of such outsourcing, implement a comprehensive change management framework for the products and services provided by the NBFC, enhance business continuity and incident management plan, develop risk assessment tools, and align board and senior management oversight with the revised resilience expectations. Master directions on fraud risk management. Now, the master directions on fraud risk management were introduced in July and were made immediately effective on NBFCs in the base layer having asset size more than 500 crores, middle layers and upper layer NBFCs, including HFCs. Now, this direction also supersedes the erstwhile master directions on monitoring of frauds for NBFCs 2016. The major requirements that are listed under this fraud directions are formulating a board-approved policy for identification and procedure of fraud, establishing a system to issue show cause notice to borrowers against whom the allegation of fraud is being examined, formulating a special committee for identification of frauds, and implementation of an early warning signal framework. Now, this early warning signal framework is made applicable to only middle layer and above NBFCs. Base layer NBFCs are exempted from the same. Master directions on willful and large defaulters was introduced on July 30, 2024, consolidating and replacing all the prior circulars for the same. The circular was introduced in July and shall come into effect from October 28, 2024. The directions is applicable to all NBFCs in the middle layer and upper layer, including HFCs. Now, the intent of the circular or the direction was to enhance credit discipline, ensure accountability, and prevent defaulters from accessing further finance. The directions provide for a transparent process for identifying, classifying, and reporting willful and large defaulters for the NBFC. Now, the major actionables for NBFCs under the directions are to adopt a board-approved policy for identification, classification, and preventive measures on case of willful defaults, constitute identification and review committees, review of loan accounts of more than 25 lakh at the time of default and NPA classification for the same, report willful and large defaulters to CICs, implement internal audit mechanisms, ensure due diligence on borrowers and monitoring of fund utilization of the loan accounts. Before loan transfers, complete willful default assessment and share status with the transferee, and restrict further credit. Frequency of reporting credit information. Now, the frequency of reporting credit information to CICs by NBFCs was decreased from monthly to fortnightly to reflect more current data. The credit information must be submitted within 7 calendar days from the reporting date, that is each fortnight. Review of risk weights. Now, the review of risk weight circular revises the risk weights computation for undisbursed housing loans extended by HFCs. The intent of the circular is to ensure a more risk-aligned capital treatment, capping the risk weight on undisbursed loans at the risk weight applicable if those loans were disbursed. This leads to a reduction in the risk-weighted assets for the undisbursed portions of low-risk loans extended by HFCs. Harmonization of HFC directions. RBI has amended certain regulations applicable to housing finance companies and NBFCs to ensure harmonization between the HFC master directions and SBR directions. These amendments became applicable from January 1st, 2025. The amendments were as follows. HFCs are allowed to participate in exchange-traded currency derivatives, interest rate futures, credit default swaps, but there was no regulatory guidelines earlier. They are permitted to issue co-branded credit cards. The finalization of balance sheet of the HFC should be done within 3 months from the relevant date. However, HFCs can ask for extension to the National Housing. The periodicity of IS audit is placed at the discretion of the HFC. Investments routed through AIF in group companies shall be deducted for the NOF calculation. Lastly, if the HFC is a financial information provider or financial information user, they shall adopt specifications published by Revit. Peer-to-peer lending. Now, the P2P directions were amended on August 17, 2024 and were made effective from the same day. The amendments were as follows. The timeline for transferring funds from the escrow accounts, both lender and borrower, was made to T+1. It was RBI directed that the P2P products cannot be promoted as an investment product. And further, the credit risk arising out of transactions undertaken on the platform cannot be assumed by the P2P platform. No lender fund recycling or borrower funds shall be used, meaning that the P2P cannot use funds of one lender to repay other loans, and the borrowed funds cannot be used to disburse loans to others. The fourth amendment that was brought in was there should be no closed group matching via affiliates or service providers, and the P2P shall mandate a framework for loan pricing with additional transparency requirements. Gold loans. Now, RBI had observed certain irregular practices in the grant of loans against gold jewelry and ornaments. The major concerns observed by RBI were shortcomings in use of third parties for sourcing and appraisal of loans, valuation of gold without the presence of the customer, inadequate due diligence, lack of end-use monitoring, lack of transparency during auction of gold and jewelry, weaknesses in monitoring of loan-to-value ratio, incorrect application of risk weights, etc. RBI advised NBFCs and gold lenders to review their practices in line with these observations. Further, RBI on April 9, 2025 has introduced draft directions for gold lending pursuant to such concerns, tackling the same. Implementation of CIC reporting mechanism subsequent to cancellation of license or certificate of registration. RBI directed that NBFCs whose certificate of registration or license are cancelled shall continue to report to CICs of the existing loan accounts with them till the loan account or the loan cycle is completed or the NBFC has wound up, whichever is earlier. Amendment to KYC Master Directions 2016. RBI amended certain parts of KYC directions to simplify procedure for existing customers and enhance monitoring of high-risk accounts. There are three major amendments in this. First, that no fresh CDD would be required for existing customers opening a new account with the company or availing new services with respect to customer identification. In case of KYC data reporting to CKYCR, the data should be submitted within 10 days of opening of account. In case any additional or updation of information is there, the RE must update the CKYCR within 7 days. Thirdly, in case of KYC retrieved from CKYCR, the company would not be required to re-obtain any document from the customer unless customer information has changed, the KYC records are incomplete or non-compliant, document validity has expired, or there is a need for verification of the identity, address, or EDT or risk profiling is required for the customer. The CIC Master Directions 2025, which consolidates all existing circulars for reporting and other obligations of CICs, it also introduces two additional obligations. Firstly, as CICs will conduct quarterly checks and share findings with the credit institutions for accuracy and report non-responsive credit institutions to RBI, the credit institution should regularly update their data and comply with timelines for updates, corrections, and dispute resolutions. The second obligation that it brought on was that credit institutions should establish a system for rectification of data by the customers. Once the credit institution has updated the borrower's data, the CICs will do the same. FAQs on reset of floating interest EMI-based personal loans. RBI had issued a circular on August 18, 2023, introducing a framework for resetting floating interest on EMI-based personal loans. To aid with this implementation and ensure clarity, RBI has released these FAQs addressing some key practical aspects. A brief summary of the clarifications are as follows. The circular only applies to EMI-based personal loans and not to other loan types. The lenders must communicate the impact of rate resets both at the time of sanction and during the loan tenure. Borrowers must be provided with other options in case of rising rate scenarios, such as including increasing EMI, extending tenure, switching to fixed rate, or making prepayments. All REs are mandated to offer fixed rate options in relevant personal loan categories, and the borrower shall also be allowed to switch back and forth between fixed and floating rates as per the board approved policy of the company. The company shall be allowed to charge administrative charges, however, the same must be clearly disclosed. Prevention of financial frauds perpetrated using voice calls and SMS. Now, RBI has issued such a circular for the purpose of mitigating the frauds taking place by scamsters in the digital lending scenario. This circular was made effective immediately from January 17, 2025. This is both applicable on NBFCs, including HFCs. The major actionables for lenders under this circular are to consider the numbers on the mobile number revocation list issued by the Digital Intelligence Platform by the Department of Telecommunication, register the customer care numbers on the Digital Intelligence Platform for publication through the Sanchar Sathi portal, use the following numbering series that are use 1600 for transactional and service related calls and 1400 for promotional calls. Also, lenders shall adhere to TRICE commercial communication guidelines. Lenders shall conduct consumer awareness, educate the customers through emails, SMS, and vernacular languages about the secure communication practices. Recommendations of the 55th GST Council. Through this recommendation, it has been clarified that GST shall not be applicable on the penal charges levied for any breach or non-compliance with the loan terms of the loan agreement. Bond issuance in HFCs. Guidelines applicable to NBFCs for issuance of NCDs having maturity more than 1 year are now applicable mutandis mutandis to HFCs. Such circular has been made effective immediately. The short-term NCDs having maturity of less than 1 year shall continue to be governed by the master directions, commercial paper and NCDs of original or initial maturity up to 1 year directions 2024. Certain erstwhile additional requirements that were applicable to HFCs have been removed through this circular. The summary of changes include the removal of restrictions on exercise date, rollover, and tenure of NCDs. There is no more requirement to obtain credit rating for issuance of NCDs. No time limit for completion of the issue or issuance of the offer document. Disclosure requirements in offer document have been removed. There is no requirement for auditor certification. No requirement to appoint a debenture trustee. And certain requirements of disclosures in the board's report have been removed. Draft circular on levy of foreclosure and prepayment charges. The circular seeks to address inconsistencies and grievances arise from borrowers due to various practices among the lenders regarding foreclosure charges and prepayment penalties, especially for loans to individuals and micro and small enterprises. The key recommendations of the draft circular include there shall be no foreclosure or prepayment charges on all floating rate loans taken for non-business purposes by individuals. There shall not be any charges for foreclosure or prepayment of business loans given to MSEs and individuals up to 7.5 crore per borrower. Source of funds for the prepayment or foreclosure can be either internal or external. The waiver shall apply nevertheless. In case of special rate loans, the applicability of charges depends on whether the loan is under a fixed or floating rate at the time of foreclosure or prepayment. Any foreclosure or prepayment charged by the lender shall be in accordance with the board-approved policy on penal charges. There shall not be any lock-in period for prepayment or foreclosure. If the foreclosure or prepayment is initiated by the lender himself, then there shall not be any charges levied on the borrower. Such foreclosure and prepayment charges shall be disclosed in the key fact statement provided to the borrower at the time of sanction of the loan, and there shall not be any retrospective charges or waived off charges levied at the time of foreclosure and prepayment. Bank credit to NBFCs. RBI had increased the risk weighting of bank credit to NBFCs by 25 basis points in case the risk weight applicable to the exposure was less than 100%. The same has been restored back to the erstwhile provision, where the risk rating shall depend on the external rating of the exposure prescribed under the Basel III Master Circular. Treatment of ROU asset for regulatory capital computation. NBFC lessees or financial leases are not required to deduct the value of right of use assets from their own funds for capital of Tier 1 capital computation. However, the risk weight of 100% must be applied for CRAR computation. PSL target and classification direct. PSL targets and classification directions 2025. The master directions have been introduced with the aim to enhance the flow of credit to priority sectors while making the process more efficient for banks and financial institutions. The old master directions have been superseded by the new one. The key changes in the master directions are revision and loan limits of various categories of PSL loans. While the overall targets remain the same, certain revisions have been made in the sub-targets. Adjustments in computation of adjusted net bank credit have been prescribed. Interest cap in case of securitization and transfer of loan exposures have been removed, and modifications have been made increasing the list of eligible borrowers under certain categories. Revised norms for government guaranteed security receipts. RBI has issued certain revised norms for government guaranteed receipts, including reversal of excess provision, periodic valuation, and valuation on conversion of such security receipts. In case of reversal of excess provision, if the value of the loan that is transferred to the ARC is higher than the value of the net book value, the excess provision can be reversed to the profit and loss account in the year of transfer, provided that the sale consideration comprises of both the cash and SRs guaranteed by the Government of India. In case of periodic valuation, the security receipts shall be valued periodically by considering the net asset value declared by the ARC based on the recovery ratings. Unrealized gains recognized in the profit and loss of fair valuation of such investment shall be deducted from the capital, and no dividends shall be paid out of such unrealized gains. Security receipts outstanding after the final settlement of the government guarantee or the expiry of the guarantee period, whichever earlier, shall be valued at ₹1. With respect to valuation on conversion of security receipts, if the receipts are being converted to any other form of instruments as part of a resolution, then the valuation and provisioning for such instruments shall comply with the prudential framework for resolution of stressed assets as per June 7, 2019. And that wraps up our quick overview of the key amendments, circulars, and notifications that were issued in FY 24-25. This was just a brief summary to help you stay informed. And in case you have any queries or questions, please feel free to drop them in the comments down below. We'll answer the same. You can also download this presentation from our website. The link would be in the description down. Thanks for watching, and don't forget to stay updated and compliant.